Hi, everyone. A very good evening on this Saturday evening on this yet another Edelweiss Connect classroom session on decoding target maturity funds. I'm sure of late there will be a lot of news which you have either read or seen on this new emerging category, which has actually picked a lot of interest from investors, distribution partners, as well as media. So quite honestly, we thought that why shouldn't we, who are really the OGs when it comes to target maturity funds and the pioneers of this category in the country, to help you decode what target maturity funds really is. What is going to be our agenda for the evening today? We'll start with what actively managed debt funds are. We'll move to passively managed debt funds. We'll look at a comparison between the two. We'll look at investment options that are available to you when it comes to passive fixed income options. Then we'll move to the core of our discussion, which is on target maturity funds, what exactly they are and what are the various benefits that target maturity funds provides to all its investors. And lastly, we will move to a very interesting and easy to deploy strategy called bond laddering when it comes to investing in passive fixed income schemes, and how you can actually use this very easy to deploy strategy called bond laddering to help your investments and reduce risks further. So we'll talk about that. As usual, if at any point in time you have any queries or questions, I would request you to please put it on the chat mode, and I will respond to each and every question towards the end of our session. Okay, so on that note, let's begin. I mean, this is something which right at the start, under the mutual fund umbrella, there are fixed income schemes, and in fixed income schemes, now there is a clear bifurcation between actively managed fixed income schemes and passively managed fixed income schemes. We'll, in the next few slides, elaborate on each one of these and help you decipher each one of these in a little more detail. Okay, so let's begin with actively managed debt funds. As the name suggests, an actively managed debt fund is a fund in which the fund manager buys and sells bonds or securities, whatever you want to call it, on a regular basis. I mean, and how does he do this? He does this with regards to having an assessment on the interest rate fluctuations, on what are the yields prevailing in the market, and the credit risk that the scheme is probably holding on to. It's a very regular affair, right? On an everyday basis, there will be some buying and some selling. It would also be, to manage liquidity. So there could be various reasons, but these schemes on a regular basis buy and sell bonds in the market. What are the pros and cons and for any actively managed scheme? Possibly, you manage interest rate fluctuations better, so there is a probability of higher returns. That's obviously one very big pro that you get. At the same time, it could be a little expensive in comparison to passive fixed income schemes, and because there is an active buying and selling, there is always going to be a fund manager bias, right? Fund manager preference, fund manager bias, whatever you want to call it, and that individualistic bias can on occasions elevate a certain degree of risk, and hence we call that fund manager risk. So these are the pros and cons when it comes to actively managed schemes. Then let's look at what passively managed fixed income schemes or debt funds are. Usually they are an index funds, and just like they are in an equity scheme. So either there would be an existing index, which is getting replicated in the same proportion. Or, it could be that, an asset management company decides to float a passive debt fund. It fixes up on a strategy and bases that strategy, customizes an index to be constructed. A customized index is constructed. It could predominantly, it's either done by NSE or CRISIL. This index then has a defined maturity, defined portfolio allocation in terms of, what are the type of papers, what are the companies whose papers are going to be held, and in what proportion. It could be, investing in highly rated, AAA kind of papers. It could be investing in state development loans. It could be investing in public sector companies. It could be investing in GSECs. Okay, so it could have any or every one of these in a defined proportion. And how this actually operates is when the fund matures, the index also ceases to exist. So the index and the fund both mature at the same time. Okay, so this is another way. We'll delve a little more, in the next few slides to enhance this understanding. Just like, on the equity side, the passive in fixed income business is also growing. Okay, and passive investing is actually, across the developed worlds, doing as well, if not better than, active funds. In India too, passive funds are gaining a lot of interest. On the fixed income side also, when it comes to passive fixed income schemes, there is a lot of investor interest. There is a lot of, lot of people now moving and diverting their money on the passive side. And what are those reasons? We look at that also in the next few subsequent slides. Clearly, and when it comes to pros, of investing in passive, it is cheaper. B, because it is investing in, let's say, highly AAA kind of rated instruments, or government securities, or PSU bonds, or state developmental loans. These are those companies which predominantly are safer, and have a stability attached to them. So in that sense, your investment feels far more stable and safe. And the third, and perhaps a very, very important reason, is that in a passive debt fund, there is a better predictability in terms of the returns that we as an investor can make. Now, let me give you an example of how this works. When it comes to a passive scheme, passive schemes normally invest in bonds with a concept that is a hold to maturity. That means I am going to hold this bond until it matures. And how does this really benefit? I mean, let's assume that I am investing in a government security, or I'm investing in a state developmental loan, or I'm investing in a PSU for a period of about 3 years. And obviously, at the start of that, I would know, what is the yield or coupon or the interest that I'm going to get. So let's say I know that if I invest right now in 2022 for a period of 3 years, it will mature in 2025, and every year I'm going to, let's say, get a return of about 7 or 7.5%. Okay. Now, because I am going to hold this up to maturity on an every year basis, I will get this return, and on maturity, because it is a stable company, the probability of me getting my principal and this interest back also becomes higher. So in that sense, it becomes a far more, predictable in terms of the returns that it will get. Of course, then on the flip side, somebody would say, then that means that I am not able to take advantage of the interest rate cycles, and if there are opportunities available where I may gain from holding certain duration papers because of the way the interest rates are moving, then that obviously passive funds really don't get that, don't have that opportunity gravely, primarily because each of the paper that you're holding is on a hold to maturity time. So whenever you invest, you would perhaps have an idea of what is the predictable return. You could have an idea of what is the type of return that you may get for the period that you're staying in, for the period up to which the maturity is going to be held. To be very honest, whenever anyone invests in any fixed income instrument, it could be a traditional instrument like a fixed deposit, or maybe even a post office instrument, or any other. The primary reason for an investor to invest in fixed income, according to what I think, is that there is stability, that I know my principal is fairly safe, and B, I know how much I will make. So in terms of what is the interest or the coupon or the yield that I will get on maturity of this fixed income instrument that I have invested into. And passive schemes help you achieve both of these to a great extent. You can predict returns far better in comparison to active. At the same time, because of the high quality of instruments being held, your default risk falls down drastically. And to be very honest, that really should be, the reason. I mean, that really is the reason for which, a lot of us as investors choose fixed income schemes. So in that sense, both the primary thoughts or questions, when it comes to investing, is it going to be safe? So it is fairly stable. How much will I make? There is a kind of predictability that's available over here. Get responded to very well when you invest in a passive fixed income scheme. So that's where I think really the pros outweigh the cons when it comes to passive investing. Moving on to just a broad, type of schemes available. Then there are two broad type of schemes when it comes to passive investing. One are debt index funds, which invest in the index, and the other is target maturity. So the index could be a short-term index, could be a medium-term index, could be a long-term index. And just like in equity index schemes, you replicate the active index that is there, the index as it is. And in target maturity funds, you could define a maturity, you can create your own index, you could have your own allocation in the schemes that you want to. Again, it's defined as an investor. I would know what are the papers being held. So in that sense, there is a predictability in terms of and transparency in terms of the papers that are being held, and you can have an idea about your stability and the type of yields or returns that you would get for the period that you stay invested. The two categories of investing. You could further split it into either an index like a short-term, medium-term, long-term, or it could be for a defined maturity, right from 1 year to 15 years, whatever is your period of investment that you would want to stay invested for. Okay. Taking it further in terms of what really index funds are, I mean, clearly the benefits of index funds are that it is fairly safe. You know the index, you know the quality of papers being held in index, so it's fairly clear. It's largely transparent. You know the proportion of investment in every paper because I am replicating the invest. It is very easy to transact, and overall, it helps you in managing your investment risk a little better because of the higher degree of transparency and safety that this provides. Moving on to the core of our discussion, and that is on target maturity funds, right? And this, like I said right at the start also, this is a category which in the recent past has really, garnered a lot of interest from investors across the country. So target maturity funds are funds which have a predefined maturity, so you know when will the scheme, cease to exist. And basis that investment is made only in those bonds which either mature on or before the maturity of that scheme. Okay, so that's how the construct of a target maturity fund primarily is. You can choose to invest in these schemes either via an ETF route or a fund of fund route. If you choose the ETF route, you will buy this through the exchange. If you choose the fund of fund route, you would buy this from the AMC. I mean, that's the only difference that is there. In terms of availability, target maturity funds are now available across the spectrum. You can have a target maturity fund which is maturing in 1 year, right up to 15 years. So clearly, I mean, depending on what is your investment horizon, you could choose to invest in a target maturity scheme which directly suits your investment horizon. Okay, so that's there in terms of the number of types of maturities that you have now available under the target maturity fund umbrella. Okay, like I said, I mean, they are gaining popularity, and they are predominantly gaining popularity because of these two reasons. It's predictable in terms of returns. The interest rate risk over there is lower, primarily because it is on a hold to maturity concept. So there may be an interest rate fluctuation because of which, you may see your valuations move up or down, but because there is no trading and you are holding up to maturity, on maturity you will get fairly close to the return which was there in terms of the predictability that you had in terms of whatever the papers were promising to give you. And this is primarily these papers predominantly there is a high probability of the returns coming predominantly because they invest in highly rated bonds of either corporates or public sector companies or government securities, predominantly making this risk to default fall to being almost negligible. So that's like I said about 5 minutes back to the two reasons why people invest in any fixed income scheme, whether it's traditional or under the mutual fund. I mean, anyone wanting to invest in fixed income scheme wants to have certain higher degree of stability and wants to have an idea of the returns that he or she would be getting at the end of that tenure. So target maturity funds respond to both of these beautifully, making them the go-to schemes, very honestly, for all of us as investors in the fixed income basket. Again, I mean, at the cost of repeating maybe, but really, I mean, these are reasons which we all should, probably, internalize and, look at it. There is a predictable return, there is a low risk of default, and to help you further, if you stay invested over a 3-year period, then fixed income schemes under the mutual fund umbrella offer you something known as an indexation benefit, where your capital gains over 3 years, which are then categorized as long-term capital gains, have a significant lower rate. I mean, in the index value is capital gains of the index value is just about 20% of your capital gains post indexation. So in that sense, in comparison to traditional investments, because of the better taxation offered, your clear, even in similar returns, your clear in hand will go up. So that's a third added benefit that you get when you invest in any fixed income scheme, and that also gets passed on to the target maturity fund category under the mutual fund umbrella, of course. Okay, so when you talk of target maturity funds, like I said right at the start, we are really the original OGs, or the pioneers of this category in India, and we started with our first target maturity fund in way back in December of 2019. And we've been persistent with it right through. The industry somewhere woke up to this category, in early 2021, Feb, March, April 2021, when they started investing. And clearly, I mean, if you look at the pie chart which is there, I mean, we have a 51% share as of 31st of October 2022 in this category. And that's clearly because we were the ones who perhaps understood way before the industry that in a fixed income category, any investors who wants to invest wants stability and predictable returns, and hence this category was something which got created in the industry, where we went ahead and defined our index, looked at stable companies to be part of that index, and basis that the predictability from those papers helped investors start looking at this investment. And today this category is as big as 1,20,000 odd category, and we are at about 51% of that. Okay, so thank you to all of you who have already invested, and all of the rest. Really, this is a category where an allocation should be considered whenever we are looking at investing on the fixed income side, whenever in the future. So it's a category which helps you get stability, predictable returns over the long term, and that's what any fixed income investor predominantly is looking for. Moving on to, like I said at the start, a very, very simple and easy to deploy strategy when it comes to investing in fixed income instruments or the bond market, and it's called bond laddering. Now, what does bond laddering clearly do? Is bond laddering means that I am going to invest in bonds with varying maturity. So, for example, let me give an example, and I think that helps build further. Let's assume that you have 10 lakh rupees to invest in, and what I will then do with that 10 lakh rupees, I will, let's say, invest, for example, 2 lakh rupees in a bond maturing after 1 year, 2 lakh rupees in a bond maturing after 3 years, 2 lakh rupees in a bond maturing after 5 years, 2 lakh rupees in a bond maturing after 7 years, and my last 2 lakh rupees, I'll invest in a bond after 9 years. So 1 year, and then after that subsequent 2 years, there is going to be some money which will come to me. Now, what this very clearly does, I have invested in bonds maturing at various timelines, right? So one will mature, let's say if it's 2022, one will mature in 2023, and then 25, 27, 29, and 31. Okay. Now, what this very clearly does, this on maturity, let's say after 1 year, or after 1 year, I will get my 2 lakh rupees back. Now, this 2 lakh rupees which comes to me, I have two options. I can either use it for whatever my financial requirements was, or I reinvest this in the same ladder fashion and go beyond that 9 year, and I say, okay, now I will invest in a bond which is maturing at 10 years or 11 years, depending. Okay, now the clear two benefits that I get by doing this is, the first one is it helps me manage this interest rate risk. Now, interest rates, we know when it comes to bond markets is fairly fluctuating, right? I mean, it's fluctuating. Sometimes you get a better interest rate, sometimes you get a lower interest rate. So sometimes you would be investing at the peak. The idea for all of us, whenever we are investing is to invest at a rate which is higher, right? But will we always get high interest rates? The answer is no. And the problem is we don't know whether we are at a peak of an interest rate cycle or we are at the bottom of interest rate cycle. When I use bond laddering, really what I'm actually doing is I'm investing across various maturities at across various interest rates. So then am I at the peak or at the bottom really does not matter, because what I'll do over this period is I will average out my return. So there may be something which are giving me lower returns, there may be something which are giving me higher returns. So overall, I will have an average of this. So clear. So I mean, then this fluctuation in the interest rate cycles, this worry about whether I am in the money that I am investing is at the peak or at the bottom, goes out of the window, because I have very clearly worked on a strategy which helps me ladder out my investments. So that's your one. And second, obviously, would be that I'll be able to manage my liquidity better. So I have invested across maturities. Now, all my money is not long, or all my money is not short, right? So let's say after 3 years, I get my 2 lakh rupees and I have a requirement for financial requirement for whatever purpose it may be. That money is now made available and I can use it. So till that time, I had optimally invested it for it to get me the optimal returns that it can with a higher degree of stability. So in that sense, bond laddering also helps me manage my liquidity better, because I know that at a regular tranche, there will be some money which comes back to me. And if there is any requirement of this money, then this money is actually made available to you because of the staggered investment to use. So this, I would suggest, is a very, 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 very easy to deploy strategy, which we all should, because, the idea is, I don't know, let's say I don't know when I need the money, but there'll be a regular tranche which is coming. So that will also help. And if I can really plan that I would need this sum after so many years, then this bond laddering only helps me invest that much at that point in time and not everything. And hence the spread also helps me, have regular cash flows coming to me at regular intervals. So try this strategy. It's very, very easy to do and really, helps you average out your interest rates and manage your liquidity far better, because then you don't have to, think of redemption, because the money is anyways going to come because you had planned it. So in that sense, it really works well. Okay. So predominantly, this is what I had for all of us. And as usual, I would now like to take your questions first and respond to each one of them before we can end our meeting for the evening. Okay, we already have a few questions. So what happens at maturity? On maturity, when it comes to target maturity schemes, the money will come back to your account. Yes. So between an ETF and FOF, it varies from AMC to AMC, but it's not really much. I would suggest you check, with wherever you want to invest with regards to that, and then basis that choose whether you want to get into ETFs or FOFs. Okay, so in a scenario, there is a 2035 maturity and long-term interest rates dropped to in 2030 by 4%, just for example. Can the investor exit at that point in time with capitals? Yes, you can. So it is an open-ended scheme. Can you exit? You can exit at whatever time you want. So that option is always available. Okay, as a prudent risk management, how much of clients' long-term allocation comes into this category of investments? Okay, so I mean, very honestly, every person's requirements, every person's risk assessment is different. So there will be somebody who will be a little extra in terms of risk. So obviously his or her allocation on the fixed income side may by itself be a little lower. So in that sense, allocation in target maturity funds will be lower. Somebody may be very, very risk conscious, so the allocation on fixed income side will be higher. So in that sense, target maturity should actually, figure out as a big part in managing that risk. So it's actually very personal. Okay, so there's a question, how can we understand the YTM of a particular target maturity fund? So very honestly, it is published on a monthly basis by all target maturity schemes. So you just need to go and have a look at the fact sheet of any AMC scheme that you're looking at. So our fact sheets are also published. Everyone else's fact sheets are published. It's mandatory. It's mandated. It's something which is we all need to do. So over there is a YTM in all fixed income schemes. Now that YTM, very honestly, becomes fairly important when it comes to passive fixed income and target maturity, even more because that YTM is the gross returns or the gross yields that an investor will make if he or she stays invested up to maturity. So it gives you a fairly predictable idea of your gross returns that you would make. So in that sense, it really helps, getting a higher degree of predictability in the yields that an investor would make whenever he or she is investing in passive fixed income schemes, including target maturity schemes. Okay. So specific target maturity schemes with a 3-year horizon, look at any 2025, target maturity fund, or maybe now we are at the end of 2022, maybe 2026 may also work. So just look at it. Okay, so what is the expected return in a target maturity fund over a 3-year horizon? So over a 3-year horizon, very honestly, I would not want to, really give you yields, but you could look at YTMs of any scheme that you're interested in. That would be fairly predictable in terms of returns that you would be making over a 3-year period as you wish to invest. Can bond battery be done across TMFs? Yes, you could do bond laddering. So bond laddering predominantly would be a better strategy for passive schemes because it is giving you predictability in terms of returns and there is a safety. So your interest rate fluctuation really then starts becoming even lesser. Because you're staying up to maturity, the scheme is hold to maturity. So on maturity, you will get this, the predictability is fairly higher because of the, high quality of, instruments and bonds that they have invested into. So in that sense, bond laddering works better in a passive scheme rather than active, because in active, there'll still be trading, there'll still be fluctuation, and in a passive, the money comes to you on maturity, right? In an active, you will have to still do the redemption because the money, it's an open-ended forever scheme. So in that sense, a passive scheme bond laddering works. Obviously, it's a passive scheme management strategy. So there may be mark-to-market losses, as someone saying, if the interest rates are hardened, but because I'm holding to maturity, it may be something which is part of my valuation. So it's like if you invest in an equity stock, the equity stock price may either go up or down, right? If it's going down and I'm not selling, it may be a notional loss in my book. If it goes up and I'm still not selling, it will be a notional gain in my book. The realized gain or loss will only happen when I sell that stock, right? Similarly, during the course of my holding, in a target maturity or a passive debt also, there may be fluctuations in interest rates, which may get reflected in the NAV. Yes, that is something which will happen. But because the construct of the scheme is such that the papers are not being actively traded, and the companies are stable, so whatever the commitment in terms of coupons the companies had made, that coupons will be paid, and on maturity the principal will come. It becomes actually fairly predictable, and even though there may be notional gains or losses, it really would not impact you towards the end, because the returns are predictable and the quality of papers is fairly stable. Anyone else? Any other queries, questions? Okay, so on that note, thank you very much for your time on this Saturday evening. As usual, it was a pleasure, and I hope through this session I've been able to help you understand and have far more concept clarity on this very fast emerging category of investments called target maturity funds. And the next time you are looking at fixed income instruments, do consider this category for your investments, because it really checks all the boxes and helps you in your investments on the fixed income side. So once again, thank you very much, and we will connect again with a new topic in a couple of months. Till then, thank you very much, and thank you once again. Bye-bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.